So we're going to look at Apple stock and we're going to calculate the intrinsic stock price using prior financial information. The first thing we want to do is see the market cap, 1,378 billion. And now the price per share is 318.10. So they're a $1 trillion company, Apple. Pretty amazing. Next we need the free cash flow. And this is the best way to calculate the stock price for a company is using free cash flow. You estimate the free cash flow out into the future and then you discount it back to today's dollars. Next, we're going to look at net income. And net income is part of the model, but the reason we don't use net income as the predictor for the value of the company is because on the income statement, there's a lot of non-cash items, and they also use accrual accounting. And this makes it really difficult for valuation purposes. So free cash flow is a much better indicator. And last field we're going to look at is the revenue, the sales of the company. Now we need to look at the capital structure, figure out what the discount rate is. First, we need the interest expense. That's the interest this company pays on its debt. Next, we need to find out their debt. So we go to the liabilities section of the balance sheet. Under current debt, they have $16 billion of debt that's due within the 12 months of. And then long-term debt, non-current debt, that's 91.8 billion. That's due after a year. So 91.8 plus 16 billion. And the interest expense of 3.6 million. So they pay 3.31% interest on their debt. And interest payments are tax deductible, so we need to find their effective tax rate. So what's their income before tax? 60. And the income tax is 10.5 billion. So they pay 15.94% on their taxes. So that means we have to deduct the 3.31% by that 15.94. So the cost of debt is 2.78%. Now we need a cost of equity, and we use a CAPM model to figure that out. And the beta is 1.17. So as you can see, equity is 11.3% and debt is 2.8%. So equity is more expensive than debt because it's lower in the capital structure. So if a company were to go bankrupt, the debt holders get paid before the equity holders. So there's more risk when you're an equity holder. So the weighted average cost of capital is 10.69%. So we have to discount their future cash flows by that rate. And we figured out the future cash flows based off of the inputs from earlier. And now we present value those numbers, and we come up with a value of $1.2 trillion. And when you divide that by 4.3 million shares outstanding, you get a calculated share price of $281, which is slightly lower than what they're trading at. They're trading at 318. So let's look at the stock price historically. So 280, they were around intrinsic value real recently. Maybe a couple weeks ago, and now they're trading at a slight premium. So companies don't usually trade at intrinsic value because people look at the future projections of the company and they try to estimate, will the stock be worth more today than the financials indicate, or will it be worth less? And there's a lot of things people look at, of course, things going on in the regular economy and the world will affect people's decisions. So let me know what you think, and if you want me to do another company, I'd be happy to do it. Thanks for watching.